Hello, everybody. Welcome to Clever Investments. Today, let's talk about a new type of ETF called Buffered ETF. Buffered ETF starts getting popular recently, and let's see how it works. So it tracks an index such as S&P 500 or Nasdaq 100, and then it gives you downside protection if stocks drops. At the same time, it also gives you limited upside potential or a cap, which means if stock grows by too much, your profit is limited by the cap. And very often it gives you a 1 year or 2 year term. So basically you buy the ETF, the downside protection and upside potential is designed a year from there or 2 years, depending on what type of buffered ETF you're using. And also for the downside protection, there are two types of buffered ETF. For one kind, it offers you 100% downside protection, which means your portfolio will not drop at all. And then the upside potential is also lower. Another choice is you have some downside protection, but you have also a higher upside potential. So let's use MAXJ as an example. J means June. And if you buy it June this year, 2024, you get 100% downside protection. And you get a 10% cap, which means you can get at most 10.6% of the growth in June 2025. Another example is BAPR. APR means April. So if you buy it April this year, you have 9% downside protection and 18% cap. So the 9% downside protection means if the index drops less than 9%, you don't lose any money. But if it drops more than 9%, assume it drops 19%, then your stock portfolio drops 10%. So it only protects you for the first 9% of the drop. It has worse downside protection, but also it gives you a much higher cap, 18%. So let's look at MAXJ further. For the MAXJ, if you look at its profit and loss graph, it has the same shape as a bull vertical spread. So basically, if the stocks drop, you don't lose any money. Assume the current stock price is 100. So if stock drop, your profit or loss will stay at 0. And if it grows, until it grows by about 10%, your portfolio will grow as the stock. But after the stock grows more than 10%, you no longer get more profit. So this shape is the same as a bull vertical spread or the collar. So how do we implement a similar vertical spread? We can buy a call at the current price, which is 100. And then we can sell a call at the cap, which is a higher strike. It's around $110. But exactly how do we reproduce this in our own stock portfolio? Assume for some reason you don't want to buy this ETF. Well, let's look at this. So I'll use this MAXJ as an example, and I pick the date, June 20th, because that day has the stock option expiring. The real ETF MAXJ, it uses June 1st, and they use customized stock option with customized strike and expiration date. I cannot do that. So the result I calculated might be slightly different from what they have. And on June 20th, 2024, SPY, which is the index for S&P 500, it's 547. And we can calculate the cap by adjusting it by the 10.6%. So you get 605. And then the call price on this day for these two strikes are $43 and $15. This means you can buy the call spread and $28.45 per contract. And now assume we have $1 million to play with. So $1 million divided by the stock price, 547. You can buy about 1,800 shares or 18 contracts of vertical spreads. So let's do that. To be accurate, let's buy 18.28 contract of vertical spreads. So that will cost us $52,000. And our account has $1 million. So you get about $948,000. And we can invest it in a 1-year treasury. And if you look at the history of the treasury rate, the 1-year rate on that day is 5.1. So we can get a risk-free return of 5.1%. And after 1 year, this treasury will give us interest of about $48,000. And we have spent $52,000. So that means our out of pocket is about $3,600, which is 0.37%. So this is our real cost. No matter how low the stock drops, you only lose 0.37%, which is very close to zero. And the max gain. The max gain is if the stock grows beyond 605. And then you get about $100,000, and it's 10.6%, which is very close to the camp that this ETF provides. And if the stocks drop, we can only protect it when it drops to below $545, which is the strike price we buy. Although SPY is 547, there's no such call option at that strike. So I have to pick a closer one, which is 545. So this is 0.37% lower than the current price, which is close enough. So would you do it yourself with a buffered ETF? Not very likely. So you save the management fee, which is about 0.5%. But you do need lots of money to do that. And also the tax treatment, if you do this yourself, it's not very good for you because you need to pay high tax on the interest. And with the ETF, the tax treatment should be better. You get capital gain, long-term capital gain. And when would you want to use this buffered ETF? This is similar to the caller question. If in the medium term, you want some upside potential, but you do need to use that money and you don't want to lose it, then you could use this ETF. So for example, you're saving money to pay for a down payment for a house, and you want to use it in about a year or two, then buffered ETF could be a choice. Or if you're retired, you want some money to be stable because you will use it, then you could also consider buffered ETF. It reduces both risk and return. If you have money you want to invest for a long time, maybe you can just buy and hold the index, which likely get higher return in the long term, but it does have higher risk. Okay, that's all for today. See you next time. Thank you.